If you've been online recently, then no doubt you've seen warnings of impending market crashes. Yet the market continues to reach all-time highs. But then there's so much uncertainty from Delta. Wait, but then the market skyrocketed in 2020 from the first spread. But then everything now is overvalued. But the Fed is going to start reducing tape rates. Interest rates are going to start. But the job reports, everything is shutting down. But gold is just down. The economy is not recovering. There's just way too much going on right now. I'll just hold off from investing because eventually it'll get really high and then it'll drop, right? Sounds reasonable, right? Well, not necessarily. Hey friends, my name is Vincent and my goal is to make finance more accessible through bad jokes and puns. So let's talk about what's happening, what led us up to this point, why the stock market is actually getting cheaper, and most importantly, how can you make money from it? And to truly understand this paradox, we'll have to start here. Back in 2020, when the illness hit, it drove the economy into a deep recession, and by March, the S&P 500 tanked by 30%. Millions lost their jobs from shutdowns, businesses were closing, people were scared, and they spent less money, so the government had to step in and take action. They cut interest rates to near zero, they backed nearly $500 billion in loans to businesses, and they sent out stimulus checks to millions of Americans, and suddenly, the stock market rebounded, leading to one of the most overvalued markets in history because people now had extra money in their pockets and they decided that they wanted to start investing. And then there were also very few investment alternatives out there. Bond yields were at historic lows, saving accounts were giving you nothing, and don't even get me started on just holding your cash. And all of this led to countless flashing signs from the Buffett indicator to the Shiller PE ratio, all exclaiming one thing: the stock market is overvalued. The stock market is overvalued. And because of this, experts like Michael Berry, who rose to fame for predicting the US housing market crash in the 2000s, warned that the market is dancing on a knife edge. And that was earlier in 2021. And now we can sprinkle in some uncertainty from China's ongoing crackdown, a dash of new illness variants, a sparkle of economies reshutting down, and a pinch of the Fed ending fiscal stimulus eventually, and the ingredient list goes on and on and on. But here's where it gets really interesting, because at the same time all this is happening, all this fear of overvaluation, indices surging to brand new highs, some experts are starting to say that stocks have actually gotten cheaper over the past few months. What? And here's why. One of the most popular measures of value in the stock market is the price to earnings ratio. And simply put, it takes the current share price and divides it by the current earnings, aka profits, per share. A high PE ratio means that the shares are expensive compared to the current earnings, and a low PE ratio means the opposite. And what we've seen so far everywhere in the market is that the ratio is really, really high. But there's another metric that's also very common called the forward PE ratio, which is the PE ratio's long forgotten cousin. The difference in the forward PE ratio has to do with the earnings per share, so this guy down here. The forward PE ratio uses estimates of future earnings, so the denominator would switch from the current earnings per share to projected earnings per share. If the forward PE ratio is higher than the long-term average, then that is expensive. If it's below average, then it's considered cheap. And here's where your mind is going to be blown. If we zoom back, the forward PE ratio of the S&P 500 reached a high of 23.6 in August 2020, and at this time, the S&P 500 was trading around $3,500, and this was about a year ago. Today, the S&P 500 is trading around $4,400, so you might think that the forward PE ratio is a lot higher now, right? Wrong. At the end of July 2021, the forward PE ratio was 21.2, despite all the gains in the S&P 500. And what's really, really crazy about this is that the forward PE ratio actually continues to trend lower. Wait, hold on, dude. Are you sure? Is this right? Huh. Well, I'll be damned. You're right. Now, to be fair, the forward PE ratio right now, it's still the highest it's been in nearly 20 years, but some analysts out there, they don't think that the historical average make much sense anymore, and we shouldn't place much weight on it given all the recent drastic changes that might actually transform how we view all of these valuation indicators forever. But before we get into these details, I would very much appreciate if you could turn that like button into a beautiful blue, subscribe, and hit that notification bell. It would truly mean a lot to me. We've actually seen improving earning expectations the past 2 quarters in 2021, where a record number of companies actually blew analyst expectations out of the water. Seriously, Google blows Q2 earnings, and you'll see countless companies from Facebook to Crocs to Tupperware brands do this. All in all, more than 90% of S&P 500 companies have beat estimates on both the bottom and the top line for for Q2 of 2021. The main reason is because analysts were very conservative with the original estimates, and this goes all the way back to 2020 because no one knew what the hell was going to happen from the illness. And as a result, analysts slashed their expectations and projected lower earnings just to be on the safe side. But as we all know, surprise, surprise, companies actually reported better than expected earnings quarter after quarter. And as a result, the forward PE ratio over the past year has been artificially high because analysts projected future earnings to be artificially lower. And remember, forward PE ratio is the current share price divided by the estimated future earnings. So if the denominator is lower, then the ratio becomes higher. And the reason analysts aren't placing too much weight on historical averages is because of these two reasons. First, analysts say that historically, low interest rates are supportive of higher valuations because low interest rates provide an added boost to earnings because the cost of borrowing money is much lower. Second, the S&P 500 is becoming more comprised of tech companies, which has justifications for higher valuations because of their growth prospects. As of September 30th, 2020, the S&P 500 had a 22.6% weight to its top 5 holdings, which are all technology-related companies such as Apple, Microsoft, Amazon, Alphabet, and Facebook. But it's not just the top 5 stocks, it's the entire information technology sector's composition within the S&P 500 as well, which has grown over the past couple of years and now makes up more than 28% of the entire S&P 500. And all this optimism of the current valuation in the stock market is echoed by the chief investment strategist at Oppenheimer, who says that he feels pretty comfortable with equities over the next 12 to 18 months and set the S&P 500 price target to $4,700. Goldman Sachs also increased the price target to this level and said, that sounds pretty good. Does that mean that I should buy everything in the stock market right now? Not so fast, because unlike my favorite cookies, Oreos, it's not black and white, and there are some very dangerous problems on the horizon that's making a lot of investors shit their pants. But first, if you're like me and you find it challenging to stay updated with the market news every day because there's just way too much to read everywhere, then good news, no pun intended, I created Daily Market Briefs, a daily newsletter that highlights the most important news for you every single morning so you can read it in under 1 minute. It's 100% free and you can sign up in the link down below. The first problem is that the forward PE ratio is not everything. There are many more ratios that can help determine if a stock is a good or bad investment. And honestly, I'd say that the forward PE ratio is actually more speculative than the other indicators for one reason. Analysts are terrible at predicting things like interest rates, the stock market performance, and they're equally as bad at predicting company earnings because, simply put, analysts are overly optimistic. Historically speaking, projected forward earnings are on average about 10% higher than subsequently realized earnings. And although analysts underestimated earnings since 2020, there's no way to tell for certainty what will happen next, especially with the next reason, which is one of the biggest problems we have in the markets today. Margin debt. Margin is the debt that investors take on to buy things like stocks, and it's a way to magnify their gains as well as their losses. And in May of 2021, margin debt hit a fresh all-time high of $862 billion. This number has more than doubled over the past 8 years. And here's where it gets really scary, because guess where a spike in margin debt has been observed before? Never mind, I don't know why I asked you guys to guess. It's not like I can hear what your answer is, but why don't you leave a comment down below, and then in 2 seconds, I'll give you the answers. Okay, ready? Well, it happened before the dot-com bubble and also before the 2008 financial crisis. And I'm not gonna say that it's gonna happen again in 2021 or 2022, but statistically, there's a higher risk of a correction at these levels, and the risk becomes a problem when a margin debt becomes a margin call, which is when the brokerages want their money back. And if the investors don't have their money, then they'll need to sell their asset. And this chain reaction will go from greed to fear, and people will run for the exit. The last major problem that's looming over every investor's head is this. And depending on how far you're looking into the future, then interest rates justifying higher valuations may not hold for long, because the Federal Reserve is expected to hike interest rates within the next 2 years, which would really cool valuations down. Because if interest rates are raised, then consumers will reduce their spending because the cost to borrow money becomes more expensive. When spending goes down, then businesses' revenues and their profits decrease. So companies are not only are they susceptible to higher borrowing costs, but also from decreasing consumer demand. So what's gonna happen? And unfortunately, Mr. Magic Lamp over there won't tell me what's gonna happen, and since no one else in the world has another magic lamp, really it's all guesses from here on out. But regardless of what happens over the next year or two, here's what I've been doing with my portfolio. I've been reallocating my portfolio to more stable companies, I'm continuing to dollar cost average into my long-term holdings, and I'm beefing up my analysis on companies from fundamentals and also including DCF analyses, because I want to be even more strategic with my buys and sells. And I'm also ignoring the short-term volatility in the market because I know in the long term, stocks are gonna go up. If you wanna see exactly what I'm doing and access all my research reports and discounted cash flow analyses, check out my Patreon, the link is down below. And if you wanna check out my favorite stocks that I'm holding onto for life, this video is gonna tell you exactly that.